Morning. Today's Monday, June 24th. Hope everyone had a nice weekend. I had my sister in town visiting, meeting our little guy for the first time, so that was fun. Callie, thank you for coming down. I hope you make it home safely. She had some flight issues last night. American Airlines is not her favorite airline at the moment. But got a handful of things this morning to chat about. Stock and bond market last week. Not a tremendous amount of movement. That is topic one. Topic two, we have all-time highs. S&P hit an all-time high. Again, it wasn't a ton of movement from start of week to end of the week, but it did creep up to an all-time high on Thursday. We'll chat about that. May retail sales report came out, new housing starts, and then the Congressional budget office revising the deficit forecast. So kicking her off here. Market mostly unchanged. S&P was up start of the week to the end of the week about 75 basis points, and then in the bond market we had the 2-year and 30-year yield curve became 2.5 basis points less inverted, so not a tremendous move, and that was entirely as a result of the 30-year bond, its yield to maturity dropping marginally. So S&P hits a new all-time high on Thursday. Something that we get, I think, as markets hit highs, people tend to get nervous. So it's an analogy we've used quite a bit. That think about your portfolio, value of your portfolio like a yo-yo. It's going to go up and down, obviously. But think about it's as if you're using a yo-yo and walking up a hill. So long-term, markets move upwards. Your accounts are going to go up and down, but as you're hitting new highs, your portfolio is hitting new highs, the market's hitting new highs, it's going to drop to when things correct or adjust, they're going to drop to the lows, or the air quote like bottom of the market bottom is going to be higher than it was the last time. So using a yo-yo, walking up a hill. And another interesting thing, Fidelity put out a study that what happens in the 12-month period following new highs in the market versus 12-month periods where the market didn't hit a new high. From 1950 to now, the S&P's averaged 12.7% after markets hit, after the S&P reaches a new all-time high versus 12.4% when that isn't happening. So S&P. Fidelity would actually argue that it's a sign of strength for markets, not that you need to be worried about kind of a bubble. Additionally, if you're still working and you're adding to accounts, retirement accounts, 401ks, 403bs, as markets fluctuate, you're getting more shares at lower prices when markets are down, and then participating when markets go up. So just trying to drown out the noise a little bit. May retail sales. Report was a little disappointing. It was 10 basis points lower than the expected, and then they went back to April, as they often do, and adjusted those numbers down another 20 basis points from 0% to negative 0.2%. This is something that the Fed's going to keep in mind kind of as they're looking at when to cut market or cut rates in the future. With that is going to be housing starts, which in May dropped to the lowest levels since June of 2020, when obviously we were kind of right in the heart of COVID, and home builders were a little panicked, I think. That being said, median existing home sales hit a new high of just north of 419,000. It is 5.8% higher than last year. Again, something the Fed's going to kind of have on their radar as they're thinking about when to cut the overnight rate later in 2024. Lastly, I mentioned the deficit forecast being adjusted. So this sounds like our government. They're bumping it up from 1.5 trillion with a T to 1.9 trillion. Obviously, the Treasury Department's going to have to figure out how to pay for that. If I had to wager a guess, I'd probably say new treasury issuance. but time will tell. Questions, comments, concerns, do not hesitate to reach out. Hope everyone has a wonderful final week of June, and then we're heading into July, 4th of July. That is my favorite holiday. So have a good week, and we'll talk soon.